Welcome to episode 5 of the Fund and Gain series, The Road to Your Financial Future. In episode 4, I showed you the arithmetic needed to compute your investing rewards and your risk exposure, at least as much risk as can be revealed by the standard deviation. There were quite a few tables and charts and graphs showing historical data. Hopefully you found this exciting and interesting because this episode continues with more charts and graphs. So I call this episode Charts and Graphs and Correlation 2. The real purpose is to use charts and graphs as a concise and compact means to explore the concepts of diversification and correlation. We can then simply apply these to construct a simple, diversified, multi-asset portfolio and to view its performance over a longer time period. And when I say longer, I mean 15 to 20 years, which is a lot longer than the typical time periods that you see reported. And I think it's necessary, even critical, for you to have a long-term outlook to anchor your expectations and to guide your investing behavior. Now, I can say this based on my own experience. I was just starting my career in the late 60s. I duly began to buy some stock mutual funds then. At the same time, my son was born, my wife and I bought a house, and we had all kinds of expenses. I looked at my portfolio around 1974 and said, "This is ridiculous," or something to that effect, and I sold everything. In hindsight, the S&P geometric return from 1969 to 1974 was minus 3.4%. This means had I been 100% invested in an S&P index fund, my portfolio value at the end of 5 or 6 years would have been something around 80% of what I'd actually put in over those years. And actually, as I remember, it was worse than that. The U.S. stock market took a huge hit between 1973 and 1974. All I can say is from today's vantage point is that had I constructed my portfolio then based on what I know now, I might have kept investing instead of waiting another 5 or 6 years to restart. Hopefully you can gain some benefit from my experience. You will always have to balance competing demands on your limited finances. Your investments will always have some down years, but you have to keep at it. I can say that, but I can also imagine myself just starting to work and save, say back in, say, 2000, and then going through the next 7 or 8 years ending with 2008. So in this episode I want to construct a fairly realistic saving and investing simulation using real data from 1990 to 2010, and it shows the benefits of hanging in there. It demonstrates that the sooner you start investing the better. If you start early and stay with it, you actually put in less of your earnings compared to starting your saving and investing late and then trying to catch up just before you retire. Diversification is an important thing that I learned the hard way too. Now, unless you are brand new to investing, you have heard that you should diversify. Intuitively, it means don't put all your investment eggs in one basket. What does diversification really mean, and how do you actually accomplish it? Had I really understood this concept, again, I might have had a better experience in my early investing days. So exploring diversification takes us back to previous discussions of asset classes, so let's start with asset classes. Now, I've mentioned these numerous times, and I've showed a table, I think back in episode 2, 04 Tuna, listing a number of asset classes. And in the last episode, Basic Fundamentals, I illustrated return calculations with one asset class, the U.S. large cap stocks. I also showed some return data for a second class, U.S. investment grade bonds, using the Barclays Aggregate Bond Index. The definition of an asset class is pretty fluid, and often when somebody wants to sell you something like gold coins, they try to legitimize it by calling it an asset class. So you have to be careful. In this episode, I will stick to a few of the recognized tried and true asset classes for which I have historical data. Now, each asset class has one or more benchmarks or an index, and we can use these to track the performance of the various asset classes. I will use the S&P 500 index to track large cap stocks, the Russell 2000 to track U.S. small cap stocks, and the Barclays Aggregate Bond Index to track investment grade bonds. For international equities, I will utilize the MSCI EAFE index, and finally the NAREIT Equity REIT Index will represent U.S. real estate investment trust. Benchmark data is very important. Without it, measuring and judging your portfolio performance would be very difficult. Fortunately, with a few exceptions, benchmark performance data is readily available on the internet. I hacked together short descriptions of each index from the various websites, which I will quickly read, and you can get more detail from these websites. The S&P 500 includes 500 leading companies and leading industries of the U.S. economy. It focuses on the large cap segment of the market with approximately 75% coverage of U.S. equities. It is often used as a proxy for the total market. The Russell 2000 small cap. The Russell 2000 index measures the performance of the small cap segment of the U.S. equity universe. It includes approximately 2,000 of the smallest securities based on a combination of their market cap and current index measurement. Barclays Capital Aggregate Bond U.S. Investment Grade Index. The U.S. Aggregate Index covers the U.S. dollar-denominated investment grade, fixed rate, taxable bond market of SEC-registered securities. The index includes bonds from the Treasury, government-related, corporate, mortgage-backed securities, asset-backed securities, and commercial mortgage-backed securities. The MSCI EAFE is Europe, Australasia, and the Far East. It measures international equity performance of developed markets outside North America and is comprised of 21 country indices. The FTSE Nareit Equity REIT is comprised of U.S. REITs that own properties and includes the following sectors: industrial, office, residential, self-storage, healthcare, lodging resorts, retail, specialty, and diversified. So let me start with a table of historical data for 4 asset classes: large cap stocks, small cap stocks, investment grade bonds, and equity REITs from 1979 to 2010. The returns in standard deviation units are percentages. And these furnish a longer term picture of the performance of these asset classes than you'll get in the typical 3 or 5 year chart. Now these charts also compare the asset classes over a common time period. Now you can see for the U.S. stocks, large cap and small cap, that the arithmetic average return for the period exceeds 13% and the geometric return was around 11.5%. This really looks great. But these are not stable metrics, at least over a normal human investing lifetime. And begin dates and time periods used for the calculations make a huge difference. In the last episode, I used data from 97 to 2010. So as a comparison, this next table shows performance from 1997 to 2010 for the same benchmarks. In this shorter time period, returns are down and volatility is up, with a lone exception of the standard deviation for bonds. The S&P arithmetic average return is less than 8% compared to the 13+% for the longer period. The financial debacle of 2008 had a lot to do with this. The point here is that you can make some judgments about relative returns and risk, but I don't see how you can pick an exact number for an average return or the standard deviation. And personally, I think the longer the time period, the more representative the number will be. But the problem then becomes that, just like the example of tossing coins many times in a row, where you get runs of several heads or several tails, you can sustain runs of several years and either higher or lower returns, such as we see in our examples here. And this can be deceptive. You cannot control Fortuna nor even predict her rewards with high accuracy. So how do you deal with this? The short answer is diversify. Now, diversification forms a cornerstone of modern investing. Common sense says don't put all your eggs in one basket. What does it mean, and how do you accomplish it? If you buy several funds or even individual stocks, how do you know if you're really diversified? Now, there are 2 basic ideas behind diversification. The first is you really don't know how well a particular asset will perform in the future, so you need to bet on one or more than one, so to speak. The second idea is that when some assets decline, others will rise, and the result will be an overall portfolio value that's less subject to wild swings, less overall volatility, that is. So diversifying across asset classes should help smooth your returns and reduce the overall risk of the portfolio. Correlation is the metric used to quantify how assets move in relation to each other. And one way to look at this is that the price movements of one asset predict the price movements of another asset. So for 2 assets that are highly correlated, when one goes up, the other goes up also. And when one declines, the other does as well. Now, correlation values range from -1 to +1. Assets with a positive correlation move in the same direction, and negatively correlated assets move in opposite directions. And for a correlation coefficient of +1, assets move exactly the same, and for -1, completely opposite. A zero coefficient means that asset movements are totally unrelated. Now, correlation does not mean that one thing causes another, but just that there is a pattern to their movements. And the goal for investors is zero or negative correlation, and you're generally going to settle for low positive correlation. This table shows what is called a correlation matrix, and it's computed using the historical return data from 1979 to 2010 for the asset classes we've been using in our previous example. Each asset has a correlation coefficient of 1 with itself, and the table is symmetric about the diagonal. The question then, how do you interpret these? You see that the bar-cap bond index has weak correlation with just about everything else, and the correlation range of 0.05 to 0.24 between stocks and bonds I would call weak. The 0.80 correlation between the large cap stocks and small cap stocks seems to me to be strong. I don't think there's a hard and fast rule, and given that asset classes you select have a reasonable return at reasonable risk, the less the correlation between asset classes, the better for you as an investor. Now, the correlation matrix for 1997 to 2010 presents a different picture. The three equity classes are even more highly correlated, and the bonds are now negatively correlated with all three equity classes and close to zero correlation with REITs. And one message from all this is even more emphatic, I believe. This is include bonds in your retirement portfolio. So why should you care about all this stuff? In the previous episode, I mentioned my experience choosing from among various funds for my 401k. I looked at 3-year performance and I picked 2 of the best performing funds. In retrospect, I really picked only one asset class. So as an example of kind of what I did then, I've compared 4 funds: VMIHX, OAKLX, DREVX, VFINX, and you can see the list on the screen. The first 3 are managed funds considered large cap blends by Morningstar, and VFINX is the Vanguard Index Fund that we have seen before. I included the S&P return itself as well. Now you can see the arithmetic mean return and the standard deviation for each, and I also computed the correlation matrix. The data covers only the period from 2002 to 2010 because the inception date of FMIHX is 2001. The point here is all these funds are pretty much the same asset class, large cap. And you can see the lowest correlation coefficient between any fund in the S&P is OAKLX at 0.89. So whatever happens to large cap stocks in general happens to all these funds. They will move in lockstep, and you are not really diversified. And you can see that FMIHX and OAKLX outperformed the S&P benchmark significantly over the time period here, but we have seen that outperformance can be ephemeral. But the larger problem with 401k plans is you have to choose from the generally narrow list of choices presented to you, and sometimes the funds will be new and have limited performance history anyway. And I think the long-run best option is to go with an index fund if it's available, and most importantly, you have to be clear about which asset class is represented by a fund. Whatever your option, you can get data from Yahoo and use Excel to review longer-term data to compute correlation between the fund and its stated benchmark and between the funds that you're contemplating. The idea is to make sure that you're really diversifying and not merely duplicating. So what happens when you diversify and construct a portfolio comprised of several asset classes? We have the tools to examine this. So as a very simple example, let's use 3 really basic asset classes: the S&P 500, the bar cap aggregate bond, and the Nareit index. I've constructed a very simple portfolio with equal proportions of each. That is 1/3 S&P, 1/3 bond, and 1/3 REIT. To compute the yearly returns for the mix, we simply weight the return for each individual class accordingly for each year. Now take a look at the metrics for the 3 asset mix and compare them to the individual classes. Notice that the 3 asset portfolio does have a lower average return than the REIT index, which shows the highest return during the period, but the standard deviation for the 3 asset mix comes way down. By combining asset classes in your retirement portfolio, you can adjust the risk exposure level of your overall portfolio. You could easily have a 40-40-20 ratio or any other ratio. Once again, I think it's sound to always have some portion of bonds and to increase the proportion as you age. We can also construct an index value for the combined portfolio, just as we have done for a single asset class. And you can see here the gyrations of each individual asset class along with those of the three asset mix over the time period. And note that early in the period the S&P was up and the REIT index was down. They kind of canceled each other out. And the bond index shows a nice steady growth and provides stability to the portfolio. You can see with the combined portfolio you end up ahead of all the asset classes save the REIT index, but you can't know ahead of time which asset class will outperform. And even if you had been 100% invested in REITs early in the period, you have to ask yourself if you would have stayed the course after facing 2 years of very significant losses. So diversification clearly has its benefits, and one of them is to help you maintain your investing composure during down years. This is a good place to insert a reminder. With different asset classes, you have a mix of apples and oranges. You expect some classes to perform better than others at any given time. So as in the above example, don't get caught in a trap of selling one class, REITs in this case, say, because it has not done as well as another class for a couple of years. Stick to your allocation. I also need to point out an important factor. The calculation assumes that for each year we have exactly the same proportion of 1/3 for each asset class. This illustrates one of the key requirements of asset allocation. You have to rebalance your portfolio on a regular basis, say every year, in order to maintain a consistent allocation over time. By rebalancing, you sell some portion of the assets that have gained and buy some of those that have declined. And this means you sell winners and buy losers, and this is probably not something you would naturally be inclined to do. So as the next step, I want to go into an example of annual contributions, more real world. And because the significant thing that's idealized in the previous example here is that I start with a lump sum investment at the beginning of the time period for each asset class. But you, in actuality, will be adding money via your savings on a regular basis over a period of many years. And thus you will buy and sometimes sell assets at different prices over the course of your working life. Now, this is a good thing. This is dollar cost averaging. Through regular purchases over time, you sometimes buy at high prices, sometimes low. But you have to keep going when it's the hardest, which is when the market has declined. So I want to show a simple example of what happens as you invest regularly over a period of years. And let's expand our asset mix and use 4 asset classes: U.S. large cap, international large cap, U.S. equity REIT, and investment grade bonds. Assume you invest $4,000 annually at the beginning of each year, starting in 1990, and allocate 25% to each asset class. And this approximates the 8% savings rate of the median income. And this is more or less real world in that we're using the actual returns for the 4 asset classes over the period of time. The portfolio is rebalanced at the beginning of each year, and I'm showing you the portfolio status every 5 years because it's about all I can get on the TV screen. Now, this 21-year period was a volatile one. There were serious negative years that included the dot-com bust and especially the meltdown of 2008. In spite of all this, your retirement portfolio would have grown to $220,000 by the end of 2010. A really important thing is that you would have contributed only $84,000 of your income over the 21 years. The other $136,000 came from investment earnings. Now, while this exact scenario will not be repeated, it is instructive and hopefully you serve to anchor your expectations. If you have your investment eggs in several baskets, if you make regular contributions and take a historical long-term view that recognizes that in some years losses are inevitable, you will have the best chance of maintaining your investment equilibrium when you need it. So let me offer a quick summary and several policy guidelines. The historical data does provide us with some rough rules of thumb, such as stocks provide higher returns if you have a long enough time period. But how long is long enough? Bonds are less risky but generally offer lower returns. No one can predict which asset class will do what when. So correlation, or really the lack thereof, does offer some refuge from market gyrations. Diversification allows investors to tailor an asset mix that adjusts exposure to risk at the expense of some potential reward. Now, holding a diversified portfolio prepares investors for a wider range of possible circumstances and reduces the threat of catastrophic loss. So diversify. Don't put all your eggs in one basket. Diversify your asset classes. Recognize that most likely a diversified portfolio will have lower overall performance in some particular asset class that happens to be temporarily skyrocketing. Examine historical data for your specific investment choices. Determine that these choices truly represent the asset classes you have selected. Include bonds. Make sure you have a bond portion in your portfolio that is appropriate to your age. Maintain a constant allocation. Don't tweak your allocation every time something goes up or goes down or you hear about some great investment idea. Rebalance regularly, say once a year. Contribute regularly. And this is probably the most critical element for success. There's plenty more to talk about. I've left out of this discussion many other asset classes, such as emerging markets like China and Brazil. There are other classes of bonds, high-yield bonds, TIPS, Treasury inflation protected securities, and emerging market bonds. And I should say that the global economy is changing and that investors need to include some non-U.S. assets in their investment portfolios. There'll be much more to cover as we travel down the road to your financial future. Join me on the road again for the next episode, The Ragged Rock.